All right, welcome to Talk Tickers, where we break down the earnings calls that really matter. Today, we're digging into Zim Integrated Shipping's Q2 earnings, and, well, let's just say the market did not like what it saw. We're going to break down the shocking numbers, unpack management's surprise and confidence, and then give you our final call.
The verdict from the market? It was immediate and it was brutal. The stock just got hammered, tumbling more than 8% before the opening bell even had a chance to ring.
So, why the sell-off? Well, here's your reason. Plain and simple, a massive earnings miss. The company reported GAAP EPS of just 19 cents. Analysts, they were expecting $1.22. That's not just a miss. That's a miss by over 80%. Ouch!
Okay, so let's dig in and take a closer look at the headline numbers that really had investors running for the exits, because that earnings miss, it turns out, was just the beginning of the story.
Revenue fell short of expectations by about 9%, but just look at adjusted EBITDA and net income. They absolutely fell off a cliff, down 38% and a staggering 93% compared to last year. I mean, it paints a really bleak picture for the quarter. There's just no other way to put it.
So the big question is, what happened? What on earth drove this huge underperformance? Well, the answer really comes down to one thing: complete and utter chaos in the Trans-Pacific shipping lane.
The whole quarter was just a wild roller coaster, driven almost entirely by unpredictable U.S. tariff policy. In early April, the U.S. hikes tariffs on Chinese imports, and boom, bookings from China just evaporate. Then fast forward to mid-May, the U.S. announces a 90-day suspension. All of a sudden, demand and spot rates go through the roof. But it didn't last. By the end of the quarter, that surge was over, and weakness was right back in the picture.
And you can see the direct impact of all that chaos right here in the numbers. Their carried volume was down 6% from last year, and the average rate they could charge per container, that was down 12%. Management had to come out and say it: growth from Southeast Asia just wasn't enough to fill the hole left by China. The result? They're now expecting a pretty muted peak season for the rest of 2025.
Okay, but here's where this whole story takes a fascinating turn. This is the real head-scratcher. Because despite these absolutely terrible results, Zim's management sounded surprisingly confident about the future. A huge disconnect.
And this right here illustrates the central conflict perfectly. On one side, you have a disastrous Q2. We're talking an EPS miss of nearly 85%, revenue down, net income cratering. But on the other side, management actually raised the midpoint of their full-year guidance. So how in the world do you reconcile those two things? That's the big question for investors right now.
The CEO, Eli Glickman, basically said, yeah, we're confident. He pointed to the company's strategic shift, really hammering home their modern fleet and an agile commercial strategy as the reason they can handle these, quote, turbulent periods.
So what is this strategy that has them feeling so good? Well, when you boil it all down, it really comes down to their ships.
Here's the basic breakdown. About 2/3 of Zim's fleet are these modern new-build vessels that are on long-term charters. That provides cost stability. But the other third, that's on flexible short-term charters. And that flexibility is absolutely crucial to their whole argument.
So the game plan is pretty clear. They're leveraging a more efficient core fleet. And get this, nearly 40% of it runs on cheaper, cleaner LNG, which is a big commercial advantage. But at the same time, they've got this escape hatch. They have 34 ships up for charter renewal by the end of 2026. If the market really tanks, they can just let those charters expire and shrink the fleet. It gives them options.
Now, management also brought up a little accounting principle called pro rata temporis. Don't worry about the fancy name. All it really means is that because those high spot rates we saw spiked so late in Q2, a chunk of that revenue will actually get recognized in Q3. So it's a timing effect that could provide a nice little tailwind for next quarter's results.
But, and this is a big but, this whole strategy is being stress tested in real time. And so far, the market isn't buying it. As you can see, Zim has gotten crushed this past quarter, down almost 19%, while the broader shipping sector ETF is actually up over 10%. They are seriously underperforming their peers right now.
So let's put it all together. We have a disastrous quarter in the rearview mirror, but confident management looking ahead into a deeply uncertain future. It is time to make the call.
Where do we land on Zim after all this? Is this an outperform, a market perform, or an underperform?
We are assigning a market perform rating. Honestly, there is just so much uncertainty here. The risks and the potential rewards are both huge, which makes this a very binary situation.
Now, for those of you with a contrarian streak, here is an
Let's call it an outrageous but plausible trade idea. A long straddle using long-dated options. The logic is simple. You're not betting on which way the stock will go. You're betting that it's going to make a huge move, one way or the other. ZM is a highly levered play on global trade. If things get better, this stock could soar. If they get worse, the puts are there to protect you. It's a pure bet on volatility itself.
And as always, we have to end with this. This is not financial advice. This discussion is for informational purposes only. Please be sure to consult a qualified financial advisor before making any investment decisions.